If you are in retirement or near retirement, 30-year Treasuries are paying an interest rate that you simply cannot ignore. Seriously, should you get out of the stock market completely, put all of your money in Treasuries and just live off the interest? That idea is being circulated around a lot right now. I got that and more coming up. Over the past few weeks, and especially even the past few trading days, we have seen the 30-year Treasury, the interest rate, go up significantly. And I don't know if you're watching a lot of finance news or maybe paying attention to articles, but there are a lot of people coming out and saying, at Treasuries paying this interest rate, should you just get out of the stock market completely?
You're going to see Treasury spike because people don't trust the creditworthiness of the United States over 30 years. And so as Treasury spike, I could now buy a U.S. government bond that pays me 10% pre-tax a year. Why the heck would I pay 50 times the earnings for a semiconductor stock? So that creates the incentive for markets to move against these big AI conviction bets in the short term and pop these bubbles. And I think we're going to see more of this.
This was just one of the examples. I saw many on in social media and in the finance news over the weekend. And this comes from the All In podcast. And yes, he mentions 10% rate of return tax-free. I'm going to get to that here in just a second. But I want to be super clear about this before I sort of nitpick at the idea. If you are retired or you're near retirement, the idea of whether the moves in Treasuries and the 30-year Treasury needs to impact your investment allocation is absolutely correct. You have to reconsider things right now, work with your certified financial planner to see if there are adjustments that you need to make. Now, I saw one individual, again, this was just one example. I saw another one on Twitter where an individual said, I think they were in his early 50s, I think he said 52, and he said, I've got $1 million saved up. If I can take all that money, all my $1 million, and put it in a 30-year Treasury paying 5.2%, I manage my cash flow really well. I can live on 50 grand tax-free. Why wouldn't I do that? Fair question. And I think a lot of people are asking that. But in that situation, 52-year-old, $1 million and so on, I can think of a few reasons why you wouldn't want to do that. And for the average investor, this, even though you're going to hear a lot of people saying that's what, especially if we see the stock market continue to be volatile, you're going to hear a lot more people say, what was it? T-bills and chill, or now Treasury bonds and chill. There's going to be a lot of people saying that. But for many people, I would argue you likely don't want to do that. And one, this individual, 52 years old, take their $1 million, throw it into Treasuries and just live on the 50 grand. You're not keeping up with inflation. Typically, interest rates, and I know there's all sorts of different, depending on the length of the bond or the note or the bill, it's going to influence the interest rate. I get that, but typically interest rates and inflation move hand in hand. Okay, and if you are taking your $1 million, okay, and you're able to earn 5%, and therefore you're able to meet your lifestyle today, what's it going to mean in 10 years? I mean, the whole reason why Treasuries are paying this high of an interest rate is, well, I'll get into a few different reasons, but one is they don't really believe that inflation is tamed and taken care of over the long term, okay? And so therefore, if you take your $1 million and you throw it into something that will pay you enough for you to live on today, but that $1 million isn't going to grow in the future, you're not able to keep up with inflation. Second, and this is the biggest point of the video, and I know you're saying, well, no, isn't the idea to challenge whether you should do this or not in retirement? Yeah, I'm going to get to that. The biggest point right now is I am seeing so much misinformation or misunderstanding about how Treasuries are actually taxed. Even David Friedberg, who I actually think, brilliant dude. His brain could run circles around mine. However, he is sort of displaying that he doesn't fully understand how Treasuries are taxed. You would think that Treasuries, because they are issued as bonds by the federal government, are not taxed at the federal level. That is not true. That's intuitive. That's logical. That's not how it works. They are taxed at the federal level. They're typically exempt from state taxes. Go figure, right? Treasuries, they're issued not by the state, they're issued by the federal government, but the federal government taxes them, and they're tax-free, typically tax-free at the state level. I think what he's thinking about is Municipal bonds. Municipal bonds are actually tax-free, tax-exempt at the federal level, and should you be using the proper state municipal bond, also can be tax-free at the state level as well. So him saying you get a 10% rate of return, that's not true. He was earlier in the clip, he was saying, well, yeah, it's a 5% yield right now, but because you're not paying any tax on these others, it's close to 8, 9, 10% rate of return. That's not true. That's not true. A 5.2% rate of return, if you're in a 4.25% state tax rate, it's closer to 5.75, 5.8 is what you're actually getting. But because you're not paying state tax on it, it might feel like it's a little bit bigger rate of return when you compare it to others. But let me be super clear. It is. Treasuries are still, the interest is still taxed at the federal level. So again, going back to this example, individual has $1 million and they think, well, if I can just put it all in treasuries, get out of the stock market, then I don't have to worry about it. Put it all in treasuries, earn my 5.2% tax-free. Oh, I'll be great. Now that 50 grand that you earn, that's still going to be taxable to you. In this case, depending on this situation, might have plenty of standard deduction to wipe up and maybe mean there's very little tax on that. But treasuries are still taxable. And plus, for that individual, do you really have $1 million saved up outside of your 401k? Keep in mind, if you invest in treasuries inside your IRA, when you withdraw those dollars, it's still going to be taxable to you because it's not the instrument, it is the vehicle. It's not the instrument, it's the vehicle. And the vehicle that you're in, if it's in pre-tax, then the withdrawals are going to come out tax-free, even if you're using treasuries. And then the third reason why I would caution against for many people putting all of their money in treasuries, even though for 30 years you could lock up and you can get a fixed 5.2% rate of return or whatever it is at the time that you're watching, could be floating even higher, but you're going to want diversification. And that's the other point that David Freeberg is mentioning in that clip, and that is he believes interest rates for the 30-year treasury, I believe they're so high because they don't believe inflation is handled. They think it's going to be a big problem and a growing problem out there in the future. And I can sort of argue with that because of the money printing and all of that. But he's saying, no, this is also a knock on the credit worthiness of the United States. Interest rates are being bid up for the 30-year treasuries because people doubt or are questioning whether the U.S. will be able to pay that pay that bond back over 30 years. They're questioning the credit worthiness. And we can't know exactly how much of this interest rate move is because of that question or the question about inflation. But again, the idea of diversification, even if you think, no, this might make a lot of sense, putting all of your savings into this one instrument, probably not a wise move. And that's the right segue. Because even though for that individual 52, I would argue against taking all of your money and putting it in this, if you're near retirement, if retirement's a couple of years away and you're starting to build your investment strategy that is going to be helping you guide your retirement plan, your personal pension plan, buckets of money, or if you're into retirement, I think treasuries, 30-year treasuries at this level, you've got to consider what adjustments you need to make in your investment strategy. I think this is at a level too hard to ignore. Why? So here's a couple examples, right? If you are near retirement and you've worked it out with your certified financial planner and you've done the plan, your 5-factor retirement plan works, and you're looking at your portfolio and at a global level, you're about 60-40. 60% in stocks, 40% in bonds. Those 40% in bonds are likely in bond funds where, they're going to pay an interest rate, an average interest rate based on what they're invested in, but they're either going to go up, those bond funds are going to go up if interest rates go down, or the value is going to go down if interest rates go up. I don't know. At a over 5% rate for 30-year treasuries, I don't know if I would hold bond funds. I don't know if I'd hold a lot of bond funds. I would consider getting your 60-40, but in a different way. Maybe of the 40 that's in bonds, maybe take 20%, maybe take half of it and put it in these 30-year treasuries. And the other half continue to use bond funds or maybe diversify using some other bonds. If you can get a fixed over 5% rate of return and assure yourself of that over the next 30 years, I think you've got to rethink that bond side of your portfolio. A second example where, again, maybe at over 5%, 30-year rates on treasury bonds, you need to rethink your investment allocation in retirement. If you are knocking on the doorstep of retirement or in retirement, You could look, because I think a lot of people are going to say, well, 30 years, I'm 70 years old. I don't have 30 years. Okay. If you are near retirement or at the beginning of retirement, considering taking a chunk of dollars of your personal pension plan, your short term, your intermediate term, your long term, maybe taking a chunk of your long term dollars, put it in a 30-year treasury, earning, that 5+% fixed, and have that be part of your income plan. Basically add a new layer to your retirement income plan, and then use your personal pension plan, short-term, intermediate term, long-term, to fill in the gap, the rest of what you need to supplement your Social Security. That could be another way, creative way, that you can work with your CFP to see, gosh, with Treasury yields this high, what adjustments what impact does it make in your overall investment portfolio? I think these are significant changes. Too high. These are too high of interest rates to ignore, especially if you're on the doorstep of retirement. Those of you that are younger, I would resist the idea of saying, no, I'm going to take everything out of the market, put it all in treasuries. You're not going to get the tax savings that you expect. You're likely not keeping up with inflation, and you're not diversified. Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us here as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.